Good morning, everyone, and thank you for coming today. My name is Ray Gustin, and I chair the Roundtable's Programming Committee. This morning's session, The Challenges of Long-Term Investing in a Short-Term World, represents our latest in the continuing series exploring the impact of behavioral biases on investment decision-making. John Griswold, the Roundtable's chairman, has assembled an all-star panel this morning, and John will moderate the discussion. We're going to hear from three noted experts on the topic this morning. I will briefly introduce them now, but before I do that, let me remind you that the speakers' views are all their own and don't necessarily represent the views of the Greenwich Roundtable. Now that we've gotten that out of the way, to John's immediate right is Roger Lowenstein. Oh, excuse me, left. Or left.
Is this politically or geographically?
Roger reported for the Wall Street Journal for more than a decade. His work has appeared in the Wall Street Journal, Bloomberg, the New York Review of Books, Fortune, the New York Times Magazine, and other publications. His books include Buffett, When Genius Failed, Origins of the Crash, While America Aged, The End of Wall Street, and most recently, America's Bank. Roger has 3 children and lives with his wife in Boston, Massachusetts. To Roger's right is Will Getzman. Will is the Edmund J. Beinecke Professor of Finance and Management Studies and Director of the International Center for Finance at Yale. Professor Getzman is an expert on a diverse range of investments, including stocks, hedge funds, real estate, and art. His research also includes the history of finance in China, the origins of corporations, and the history of stock market bubbles. Professor Getzman's work has been featured in the Wall Street Journal, the New York Times, Business Week, The Economist, Forbes, and Art and Auction. Professor Getzman has co-authored a number of books, including a best-selling book on investment management and a history of financial innovation entitled The Origins of Value, the Financial Innovations That Created Modern Capital Markets. He's also the author of a 2016 book on the history of finance entitled Money Changes Everything. He's taught investment management, real estate, and portfolio management at the Yale School of Management for more than 20 years. And to the other side of Will is Arnie Wood. Arnie is founder, president, and chief executive officer of Martingale Asset Management. Prior to founding Martingale in 1987, Arnie was a trustee and senior vice president of Battery March Financial Management in its formative years and served as a global investment strategy and portfolio manager for 10 years. Prior to joining Battery March, Arnie headed the Pension Asset Department and chaired the Investment Strategy Committee at State Street. Arnie was a strong advocate of behaviorally oriented quantitative techniques to explore the fertile ground created by widespread non-rational investment choices. The persistence of investors to be patient, to zig when they should zag, and discard the lessons of historical behavior provided open invitations to unclaimed investment opportunities. Arnie served as a governor of the CFA Institute in its formative years. He was chairman of the former Financial Analyst Federation, chair of the Financial Analyst Journal Committee, and a founding member of the International Society of Financial Analysts. He has received prestigious awards from the CFA Institute, including the Daniel J. Forrestal Leadership Award for Professional Ethics and Standards of Practice. He was also a founder of the Neuroeconomic Society. He has written Fatal Attractions for Money Managers, Manager versus Client, What's the Difference?, The Plan, Trustees Under Duress, and Behavioral Finance and Investment Committee Decision-Making. He has also co-authored Individual Decision-Making and Group Decision Processes. Recent research is in the area of committee investment judgment and decision dynamics. Arnie is a trustee emeritus of the Research Foundation of the CFA Institute and editor of the monograph Behavioral Finance and Investment Management. Since its origin, Arnie has been an advisor and presenter at Harvard's Kennedy School's program on investment decisions and behavioral finance. He's hit a hole in one and knows the difference between luck and skill.
I've had 2 holes in one, and I still understand the difference. I was also referred to the flea that made the whole dog itch when I left the CFA Institute. It's a prized piece of my bio.
John, it's all yours.
Thanks, Ray, and welcome to all of you this morning. Great to have you here. And it's great to have this panel. We've been talking about this for quite a while. It's more of a continuation of some of the I would call the more governance-oriented issues that we've explored with investment committees and also, to some extent, behavioral finance. So it's good to have three experts here, all looking at the problem of long-term investment and the difficulty in this era of keeping your patience and your discipline in your investment process. I was struck by a couple of things preparing for this. One was, I think most of you who were here when Jason Zweig was here this past year received one of his wonderful Devil's Financial Dictionary books. But I was struck by his definition of long-term. It's very simple. On Wall Street, a phrase used to describe a period that begins approximately 30 seconds from now and ends at most a few weeks from now. Now that's the stage for the discussion. But in fact, it occurs to all of us, I think, that we struggle to be long-term investors, particularly today because there's so much news thrust at us. Who would have imagined in 1981, when Financial News Network was begun, that we would have so many outlets for financial and investment news on a regular basis? The mainstream media covers news now in the financial area in much greater depth than anybody would have imagined 25 years ago. The amount of information on from stock tips to economic analysis goes on 24/7, and you can turn on the TV and get any number of opinions, very often in opposition to each other at any point in time. In addition, of course, you have the headlines about investors pushing corporations to change their managements, their business models, their ways of constructing themselves. We'll talk a little bit about that today. And in fact, the pressure to perform is ever greater for supposedly shareholders and stakeholders, but in fact, very often for those who have taken huge positions in the stock. So a great deal of pressure is always present to think short term. The question is, how do investors today think longer term and maintain their focus? So we're going to start with Roger Lowenstein, who in 1995 wrote, I guess, the seminal book on Warren Buffett, who is held up as one of the most successful long-term investors. Roger.
John, thanks very much. And Ray, thank you for the lovely introduction. And I'm quite humbled to be in a panel with Arnie and Bill. I think the question, at least for me anyway, provoked me to revisiting a topic that has long fascinated me. I suspect it's fascinated many of you, and yet one which we, at least for myself, never quite seemed to satisfactorily, or at least fully resolve. Why in a world in which so many people profess to be long-term investors are so many of their behaviors obviously short-term? And for the very few of us, or the very few of you who truly are long-term, what are the challenges that presents? Bill Ruane, the late great founder of the Sequoia Fund, where I sit on the board, used to say that a person, after the basics of long-term fundamental value investing were presented, they either got it in the first 5 minutes or they never did. And if you're the type of person, who as John said, had to turn on CNN to see what everybody was saying every 5 minutes, you could explain to them all you wanted. They were never going to get it. I think Buffett who was Bill's classmate at Columbia, alludes to the same thing in his oft-repeated saw that investing well isn't mostly a matter of IQ. Most of us have the IQ. It's not really rocket science. It's a matter of temperament. When Buffett started out his investment firm, essentially a hedge fund, it was called a partnership. This is back in 1956 in Omaha. He was so cognizant of the temperamental requirements that when he went around raising money, and he was an unknown kid, nobody heard of Warren Buffett in Omaha or anyplace else in 1956. He went around to doctors, basically the people who have money, and they would say to him, "You look like a bright kid. Where are you going to invest?" And he said, "That's my business. I'm not going to tell you." And naturally, this dissuaded, not a few of them. But he wanted to do it his way. He didn't want to have them coming in, calling him up every 5 minutes or every 5 days after whatever there wasn't CNN then, but there was a Wall Street Journal and Barron's and so on, giving him advice on what to buy, what to sell, and so forth. And that he was willing to be patient for the money, and that. Needless to say, for the few who realized the kind of confidence that lay behind that approach, their children and their grandchildren are today very wealthy. But that's rare. Most of us, as John alluded to, find it very hard to turn off CNN and ignore the opinions all about us. I'm tempted, I think I will, to set the tone by an anecdote from Buffett's teacher, Ben Graham. It's sort of a homely story. You may have heard it, but here it is. It's the story about the oil prospector, and he dies, and he goes up to the pearly gates. And St. Peter says, "I'm very sorry, but all the slots for oil men are full. You can't get in. You have to go down to the other place." And thinking fast, the prospector says, "Do you mind if I have a word with my former colleagues, the ones who are now in heaven?" And St. Peter says, "That seems only fair." So he gives him a giant megaphone with little angels carved in the outskirts and so on. And he gives it to the oil prospector. And the oil prospector shouts out, "Oil discovered in hell." And there's, so there's this giant whooshing sound, and all the oil men in heaven descend to the nether reaches. And St. Peter says that was quite a trick, but you didn't violate any of the rules here, so you can come right in. And there's a pause, and he says, come to think of it, I think I'll just go on to hell. There might be something to that story after all. So we grin a little, but it's a silly story. Most of us wouldn't behave that foolishly, or would we? How many of us are tempted when we see a stock going up just to buy it? Or how many of us, having bought it, are tempted to sell it just because it's going down? I think the question poses, in one sense, what I'd call an easy escape hatch. And I say easy because some of us are professionally rewarded for behaving like those oil men, and in fact, professionally punished for ignoring them. I'm thinking right now of a company right up the road, and Jeff Immelt of General Electric, the deposed CEO, of course, of GE. By all accounts, Jeff was a pretty good CEO, but he had dissatisfied investors, including one, the so-called activist investor, Trean. Trean had been, according to the newspapers, in the stock, not your 30 days, but for a whole 2 years. Now, GE's been around for 125 years. It's had good periods and bad years, but if you're an activist fund like Trean, 2 years is a long time, too long. So Immelt sells divisions, he promises to cut costs, but it's not enough. The board let him go. I sit on the board up in Massachusetts of a little university, and briefly, I was on the investment committee. I had all sorts of suggestions. They ignored every one. The suggestions basically came down to one, which was, look, fellas, we're a university. We're here forever. We can avoid the law. If anybody can avoid the short term and invest for the long term, we can. Specifically, I wanted them to stop hedging and following other strategies which were basically designed to tamp down volatility at the expense of long-term returns. And this seemed perfectly rational to me, except, of course, I forgot two things. The head of the university may have been there forever, but the head of the investment committee wasn't forever, and the president of the university wasn't forever. They had more short-term horizons, so we hedged, and I got off the investment committee. So I call that an easy answer because those sorts of investors, and there are many, they're rewarded for behaving in short-term ways, and therefore they're acting in ways that I would call rational in terms of their self-interest. This is why, after all, corporate boards condition the street to what to expect each quarter, earnings, what they're going to get, because they live in mortal fear of disappointing Wall Street. There's a truism that businesses get the customers they deserve. So if you're a restaurant that conditions that advertises for 2-minute hamburgers, those are the kind of customers you get. You can't then decide to bake a slow baking souffle. You're going to get some very hungry and impatient diners. So it is with GE. I mean, the honest thing for them and for any corporation would be to say to their investors, we don't know what we're going to earn next quarter. It hasn't happened yet, much less do we know next year. Life's about the unexpected. But having conditioned their investors that they can predict their earnings, they get the investor customers that they deserve, and when the inevitable disappointment happens, their CEO walks the plank. It's the same way with mutual funds. They promise, or they say that they're long-term, but they live in fear of deviating from the index, and so they craft these portfolios that, in effect, shadow the index and aren't really much, but slightly off the index. Well, it's really too far along in the game then for one of them to say, I'm not going to go into Facebook or Apple or any of the known names, because that's not what their investor customers have been taught to expect. But these, as I said, are the easy examples, because we can see why each of the examples in these little dramas, the CEO, the board, the analysts, the institutions, so on, we can see why each of them acts the way they do. What interests me more, I think, and almost from a philosophical standpoint, is why the rest of us, individuals, people who are really free to act and invest as we want, why do we find it so difficult to resist the siren of short-termism? And here I think the behavioral economists have really done a tremendous service in at least pointing towards an answer. Let me start with a little anecdote. My stepson, Johnny, is a tennis nut, and I'm also a tennis nut, and we'll have these discussions about, and obviously he's younger than I am, we have these discussions about who is the greatest tennis player of all time. And Johnny will always start out by saying Roger Federer. And then in second place, he'll say Rafa Nadal. And then I'll say, Johnny, well, who's third? And he'll say Djokovic. I'll say, well, Johnny, we're talking about the best of all time. What about Sampras? What about Pancho? What about Rod Laver? And he's heard all these names, but they don't move the needle with him. The fact is, as the behavioralists have taught us, the impact of recent experience is overwhelmingly and disproportionately influential. I went on Google last night preparing for this, and you can Google the 100 best movies of all time according to various surveys, and one of them is done by Rotten Tomatoes, which is just regular people, ordinary moviegoers like us, voting. And according to the survey on Rotten Tomatoes, of the 100 best movies of all time, back to the silent movies and through Mae West and Cary Grant and Paul Newman and so on, 31 of them were made in the past 10 years. In the past 10 years, that includes, I have to get the name of this one, the 2016 classic Hell or High Water, which is about a divorced dad who robs a bank to keep from paying his mortgage. That finished ahead of and also ran such as High Noon with Gary Cooper. Oh well, recent experience casts a long shadow. It's really hard when your neighbor is making a bundle or when he says he's making a bundle to avoid what the crowd is doing, even though we know that values have and will come back to earth. If you don't think it's hard, think about right now. Right now, the Standard & Poor's 500 is trading at 24 times earnings. I'm not talking about the supposed earnings that might occur sometime in the future. I mean the actual earnings that companies booked last year. We know that the S&P ratio has never stayed higher than that even that high, for very long. Sooner or later, it comes back, to earth, quite often with a resounding crash. But it takes a really unique temperament to be able to say, I'm not going to be one of those people that follow the oil prospector down to the nether reaches. Investing and long-term investing in particular is not for everyone. It's a very lonely game. Thank you.
Thanks, Roger. Just one question for you now. You've just finished the book, or I guess last year,
Yes.
2 years ago, on the Fed. In your view, what is the effect of regulation on this problem of short-termism in the investment business? Is there a role that the Fed has played, that the SEC obviously has, but the central bank being the central figure in managing money supply?
I think regulation is really important, but the important thing is not to get volumes and volumes of regulation. It's to get the right regulation. The best example was in the 1930s, and they came up with a very simple and elegant solution, which was disclosure. And not that disclosure solves everything, but it solves a whole lot. Going to the Brandeis idea that sunlight is the best disinfectant, exposure is the best policeman, or words to that effect. In the case of the Fed, we all watch the short-term rate, and I would say, as investors, watch it to a fault. I think the Fed itself watched it to a fault and got carried away with the great import of monetary policy, and particularly the 2 chairmen ago now, Alan Greenspan neglected what in recent experience was the more important part of regulation, which is regulating home mortgages. And the idea of allowing the average American to put no money down and getting a 100% loan based on income they didn't even have to verify but was stated was madness. And you don't need 2,000 pages of Dodd-Frank, but you need someone to say, if this is the basic asset that most Americans have, it's actually the only substantial asset that most Americans have. If it's fully leveraged, it's not really an asset. We're just trading cards here, and we should put a limit on that kind of leverage and make sure they have the assets they say. So I think it's not the level of regulation. We probably have a little more than I would like to see now. It's got to be intelligent, and I think the Fed missed it in that route.
Thanks. Will.
Well, thanks very much for the invitation. Professors love to talk about their work, so that's what I'll do. And we like to talk about our recent work because that's what we're excited about, so that's what I'll do. So I've worked on and off through much of my career on long-term history and long-term behavior of the stock markets. But a few years ago, with some colleagues in France, we came across records of an ancient company that was a corporation before anybody thought corporations could exist. And the company was a mill company in Toulouse that started in 1372. Actually, it was created by a merger of smaller companies in 1372 with a remarkable charter which described what the rights and responsibilities of the shareholders were, and annual meetings and so forth. The charter was probably about half as long as this table I'm sitting at, and written in fine script. And then we were able to collect, from that point going forward, stock prices and dividends, because these shares were transferred like you would transfer real estate. And we could track every year some set of sales, and also we knew what the dividends were because they were recorded by in these annual records of this company. So that company lasted until 1946, when the French government took it public and turned it into, it was by that time milling, it was generating electricity rather than milling grain from water wheel. But over that whole time period, that's the very long term. You know, we have New York Stock Exchange data going back to the 18th century, but this company was centuries old, you know, by the time the United States started. So I'll cut to the bottom line. What's the rate of return over that long time period? What's the risk? What are the indicators that might tell you when the stock is overvalued or undervalued? The long-term rate of return for this firm was about 5% real, adjusted for inflation. That was a very comforting number. Even though this has got all sorts of survival biases built into it, the company actually didn't survive, but that was remarkably familiar to us that, you know, we look at the numbers that come out over long term. That's about the number that you would expect real for an equity portfolio. The volatility was about the same as an individual stock that we might see today. So out of this thing that starts in the Middle Ages come these numbers that tell us that the markets that we're looking at today may seem immediate and new and changing and evolving, but what they produce for people may be not that unusual. So in this sense, history can be very helpful. I've looked at a lot of other long-term markets over centuries, you know, New York Stock Exchange and so forth, but they keep echoing the fact that there is an equity premium. You have to wait to get it. There's volatility, which means that over a decade, you might get unlucky. So recent decade we noted, well, stocks were down for a decade. Well, that was just one blip in a long series of overlapping decades when they were up for a decade. So the story that, or the paper, next paper I'd like to tell you a little bit about is a paper that is painfully simple, but it's focused on this question of, should people panic when the market really moves? And so what I did is I collected information for 41 stock exchanges over the period 1900 to 2015. So I got annual data for 41 markets. So in those markets were the big markets we know today, but also unusual markets. We had Russia we had from 1900 until 1914 when they shut it down. We had China from 1900 to 1938 when they shut it down. We had Eastern European markets that were behind the Iron Curtain and shut down. So we had failures as well as successes. And so what I did is I said, what happens when the market goes up by 100%? So the idea there is people are terrified that you might be in a bubble. So we still wonder right now, are we in some kind of stock market bubble? What should we do? Well, I said, okay, let's count up all the times that the market went up by 100% across all these markets, and then follow forward. What happened the next year? What happened over the next 5 years? You'd think at least over the next year, maybe you'd get some mean reversion, and if you'd been smart enough to cash out after you just doubled your money, maybe that would have been a good thing. Well, first of all, the chance of it doubling again after it just doubled is equal to the chance that it would go down by 50% or more. In other words, you just doubled your money in a market. Should you let your bet ride? Well, it's about equal chance that you go back to where you were before last year, or you double your money again. Now that's pretty surprising. If you were offered that kind of bet, it would be an attractive one. Now, those two outcomes, only 7% of the time did it go double again, or 7% of the time did it have. So those are not the most likely outcomes, but that kind of brackets what you might expect over the next year. And over 5 years, you can well imagine what the circumstances would be. That's the long term. That's the holding for 5 years after you've just seen a lot of volatility, which after all, doubling means volatility as well as gain. And there, the evidence is really strong that holding for the long term, you'd be much better off. So that was interesting and a little bit surprising because I expected some kind of mean reversion in the markets, but really didn't find much evidence of it. Now, what's funny to me is people start to fret about a crash when the market goes up, and they also fret about a crash when the market goes down. I also calculated what happens when the market has gone down by a half. In other words, you've just lost half your money, and we all kind of know what that feels like from recent years. The evidence of rebound is even stronger. So the chance that it's going to half again, something like less than 2%, and the chance that it will rebound is something like 13%. So that is another instance where history kind of helps you. When you hear talk about a crash, take a deep breath. Let's just count up some things and see what history reveals. Now, history is not perfect because, as we know, the whole landscape of things could change. The events could intervene, like wars and so on. So we can't simply count on it, but it's helpful to know what the numbers are. So I'm going to move to one last paper that I'm fairly excited about. And that is work that I've been doing with a colleague, Dassel Kim and Bob Schiller. And Bob is one of the real fathers of behavioral finance, and we've known each other for a long time. This is the first paper we worked on together. And it's been really interesting to do so because his mind moves into things like narrative finance and, what do the newspapers say, and, on beyond the numbers, which is really kind of cool. So Bob's been he's been doing a survey ever since the crash of 1987, periodically, and now we do it at our center. We mail it out every month, asking people their views on crashes and other things, where the market's going to go. And one of the questions is something you can tell he devised right after the crash of 87. It says, what do you think is the probability of a catastrophic stock market crash like October 19th, October 18th, 1929, or I'm going to ask my colleague here the exact days.
1987?
Yeah, 87 and 29.
October 29.
Yeah.
October, whatever it was. I don't know.
Yeah, I think it's 29.
Okay,
29,
good.
29 and 29, yeah.
Yeah. But he identified these 2 days as a catastrophic crash. What do you think the chances of a crash of that magnitude will be within the next 6 months? Okay, not long term, but just in the next 6 months. What are the chances of such a crash? And we send them out to institutional investors, and we send them out to individual investors. And I will tell you right now that the people that recently answered this question, 75% of those people think that the chance of a crash occurring of that magnitude is greater than 10%. Okay, that's pretty remarkable. We took the 2 worst days in recent financial history, recent meaning like roughly a century, and then people think there's a 10% chance that most people think there's a 10% chance that something like that could happen again. That the real probability is probably, even generous and not even thinking about a normal distribution or any of that stuff, it's going to be less than about 2%. I mean, somewhere in the range of 2%. It could happen, but it's not going to be, probably it's not going to be 10%. But that's what people say. And it's just a striking thing. The average, and this number fluctuates through time, and the average individual investor over the time that Bob's been taking this survey says that the answer is about 20%. That's the average. And the average institutional investor, who should know better, says 10%. So people are walking around like Chicken Little, worried about a catastrophic market crash, or at least if they're answering the questionnaire honestly. And so you wonder where the equity risk premium comes from. It could very well come from people just waiting for the sky to fall on them and wanting a lot of compensation to make them hold stocks. So a little bit of statistics can help, I think, moderate that fear. Of course, what's really probably going on is they don't understand probabilities. They just think about the pain that this inflicts. A crash is so painful that you may conflate the awful outcome with the probability that it could happen. But that, again, that's behavioral finance. I will say that in looking for some of the reasons why they had these feelings, these probabilities, we then went to the newspapers and we collected about 150,000 articles that had the word stock market in it. And what we did is we tested to see if negative reporting, controlling for the fact that whether the stock market went up or down, does negative reporting influence people's probabilities? And we have the sort of daily information about what their probabilities are. And the answer is yes. So there's a feedback process. I mean, news is being collected by reporters about what people are interested to hear about, and then people are acting on the news. So, that when you think about the financial press, in some sense, the press represents a collective memory that we share about the financial markets. And when times of volatility occur, what do we do if we're writing about the market? We use history as a yardstick. We say, well, is this as bad as 1973? Is this as bad as 1930s? Is this as bad as 1907? And those crashes crop up a lot in the news when events get when the market gets bumpy. So my view is that we selectively use history, and we focus on the negatives, not the positives, and this is not necessarily helpful. So I love history. I think it provides a useful guide, but on the other hand, it can get us thinking about the few crashes in history that are scary, and it might take us out of, get us off our game plan in terms of long-term investing.
Thanks, Will. Just a quick question. For the average investor, whether it be institutional or individual, other than taking a deep breath, any other prescriptions for maintaining that patience and discipline through actual crashes?
Yeah, I would say private equity is the way to go.
Why?
I think it's a way. It's like, Odysseus having his hands tied to the mast. It's a very expensive way to keep yourself from jumping out of the market, but
making short-term things. Yeah. If it's tied up, if it's locked away for 10 years, you can't make any bad decisions. All right. Thanks. Okay, Arnie.
Thank you. Fascinating. I am in the investment business and have been for 50 some odd years, and so I'll come at this from a little different angle.
Arnie, pull your mic a little closer.
A little bit closer.
Thanks.
Better?
Better.
Okay.
Thank you.
I love Judith Rawlings. I don't know if you know her. You know Harry Potter? Everybody know the Harry Potter stories, part of them? Dumbledore, Albus Dumbledore, is the headmaster of this school for wizards, Hogwarts it's called. And he has a very private chat with Harry, and he says to Harry, it's not your ability that really counts in life. It's the choices you make. And I think that's a fairly deep statement if you sit back and think about it. It's the choices you make. I mean, there are a lot of people in this room who are very smart, very talented, have a lot of ability. But what you got you here probably is the choices that you made along the way. And what I'm going to try to do today is to illustrate to you how we kind of make bad choices. And I'm not going to do my card game. I'm going to tell you about a card game. And the card game involves opening up this pack of cards, spreading it out, and coming around the room with that pack of cards. And what I'm going to do is I'm going to tell you that I'm going to give you a chance to win $100. And you're going to get a card from this pack. And I go around the room, and you pick the card, and then I tell you, I basically hand you the card, and you look at it, and you put it back in the deck. And we shuffle the deck, and if we pull out that card, you win $100. Pretty simple experiment, and most people take it. But then what I do is I just twist the game a little bit. I say, I'm going to give you an opportunity to win $100, and this time I'm going to shuffle the cards, come around, and you take a card from the deck. Remember, before I gave them the card. And what do? Start licking their fingers, they look up, and they spread the cards, and they reach very carefully for that card, and they pull it in. And they look at it, and they put it back in the deck. At this point, I asked people, would you be willing to sell your card? And in the case of cards that were shown to the group and the person did not touch the card, 81% said they would be willing to do that. How about you people who actually touched the card? Would you be willing to sell this card? And they say, 62% say, sure. There's a break there from logic, right? Touch versus shown. So what we do now is ask them, how much would you accept for your card, those of you who want to stay in the game? This is a game of risk, okay? This is an uncertainty. It's 1 in 52. We can figure out the odds. This isn't a difficult problem. Very small odds, right? 1 in 52, you're going to win that $100. The people that did not touch the card said, I will sell my card for $1.81 right now. It's a pretty good profit. Guess what the people who touched the card wanted for their card? Take a guess. Now, let me just throw a number. Yes, sir. $5. $6.41. So after I'd done this literally hundreds of times in classes, I went back and I redid the classes, and I took anybody who was an MBA, had a PhD, a CFA certificate, whatever it was. Guess what they wanted for their card, of which there were 211 people in this group, in this entire group. $9.55. That's pretty darn scary. And that was an experiment I had done for many, many years, sort of teaching. And I think you learn more by teaching than you'd be some way doing in many respects. So I really appreciate what these guys do and have done for me over the years, because I have read everything that's written. So there we are. And what I want to do today is create sort of a Rosetta for you to think about the types of mistakes you make and why you make them, that we all make. And I think the first thing, and I call this the 4 Ps. So I'm going to talk about making predictions, the pressure that's on you, particularly the pressure that's on you in committees. That's my featured event for the rest of my life, is understanding investment committees, for whom I have talked to on many occasions, including creating case studies for them. Prospect theory, which of course won a Nobel Prize, Danny Kahneman, and unfortunately Amos Tversky had died, so he was not part of that Nobel Prize. And also the concepts of principles and agents. So let me start with predictions. I worked in a bank, and I had just started, and I was put in the research department to follow autos and chemicals. So I went out to Detroit, and I covered Ford Motor Company. I went out twice. And I had to meet this committee, the investment committee, and they all dressed in these heavy suits with vests and everything. And I was sweating bullets when I went in there. I was really, I was like 25 years old or 23 years old. And I gave this very long story about Ford Motor Company. And I also told this on Bloomberg TV, by the way. They got quite a reaction from particularly people calling in from the expressway in New York. So I gave the story, and I said, well, what do you guys think? And nobody really spoke up. And then the chair said, well, Mr. Wood, this is very, very, it was a thud factor report, okay? It was very thick, and he said, but we're just not going to put it on the list. And I said, sir, could you give me some information on why that decision has been made? And he said, well, my wife owns a Ford, and it doesn't work. And I was stunned, because that year Ford made 763,000 Fords. And I was really, very, very much stunned. But what I was really stunned by was the people around the room engaging what we call confirmation bias. And they were saying, oh, yeah, you know, I think there's a lady down the street who owns one of those things. And I've heard that's been in the shop a lot. That was a real lesson to me, which is the whole concept of predictions and how people handle predictions. So I would also allude to some of the, to this right here, Barron's. Okay, that was out this week. And this is a survey they do every year, and we all know who these people are. They're very famous people. But Barron's used to do this. I don't think they've done it. I think they've done it probably for 30-plus years. But about 15 years ago, they stopped and they looked at the results of these recommendations. The longs were behind. All the long positions were behind by 1.5 or 2% of the market on average. The shorts, of which there were very few people even shorted stock back in those times, they were ahead by 1.5%. So it's kind of an interesting thing, because I love reading this, and it all sounds so good, and it gets me all juiced up about doing, what they tell me I should be buying or whatever. I'm an inveterate indexer, however. The second thing I want to talk about is pressure, and the pressure that we are faced with on, particularly on committees. And I have, I can't use slides here apparently, so I made a slide. And this is a slide, and this is called the Solomon-Asch thing. And what it is, it's a bunch of lines, and here's a line X, and here's A, B, C, and you're asked which line, A, B, or C, is the same length as X. Okay? Pretty easy stuff. So this whole thing is rigged because we've got Confederates on the committee when this experiment was done by Solomon-Asch. And the first person says, well, it's B. And people who aren't Confederates are going, you've got to be kidding. It's C. It's obvious that it's, you could draw a line there. And the next person says, he's a really smart guy. I think it's B, too. And so people are starting to look around at each other and wondering what's going on here. And finally, they decide that they picked the wrong line, even though it's obvious to them which one, these non-Confederates, which one it is. I was at Sanyo many years ago, and they had things under the table. Have you guys had this for committees where you say yes or no with a button, which doesn't tell who's ringing what button, so you get the vote that way? Very interesting stuff. Very interesting results. The next thing I would like to talk about is, I guess, Alcatraz. It's Alcatraz to me is prospect theory in a very simple way. Basically losses to people are much more important than something on the range of 2 to 1 than gains. I mean, people don't like to lose. And when you went to Alcatraz, you got this great cell when you started out, and you ate with silverware and all that. You had views, and you had a little place you could farm, and you could use the rec room and all these sorts of things. But what happened when you were bad? They started taking things away from you. It was an extraordinarily good prison because most people behaved themselves because they didn't want these benefits, so to speak, that they didn't expect, taken away from them. Sort of like having your bicycle taken away when you were a little kid, when you were a little bad boy if it did something wrong. It has a very, very definite effect. And prospect theory is it's a huge area, and I'm just have so much time, so I'm just mentioning that example to give you a sense of how much losses, or the prospect of losses have on the way you make decisions. The next area is about principles and agents. And principles and agents basically are ways of thinking about who's making decisions and who's making those decisions for those people who will make the ultimate decision. I didn't explain that very well, so let me describe a situation. Again, real life thing. It was a terrible market and early 80s, and there was a thing called slaughter on Elm Street. Elm Street was in New Hampshire, and every single bank went broke. I don't know if you remember this. Chrysler got down to $2.25. General Motors is down around $5 a share. I mean, it was murderous what happened. It was a situation in which lended me, particularly, a huge opportunity, because I had been reading about this federal court judge in Texas who left the bench and started an investment company to buy bankrupt companies, which was his specialty. And he would buy them coming out of bankruptcy. So a strategy was created, and some of you may, I don't know if we ever met before, just looking around, but a strategy was built called corporate recovery. Because on my computer I found 203 stocks, most of which had no return on equity for at least 3 years. You can see what I was looking for. I was looking for potential bankruptcies. And so we went to our clients. In this case, I'll mention Engelhard because they're very smart, extremely smart people. I remember Tendler and Rosenthal and all those guys, and some of you will remember them as being the big guys in commodities and all that sort of thing around the world, Jesselson particularly. And I said, I've got this great idea for you. I want to put 10% of your account in corporate recovery. And I described what they were. They were companies that are about to go broke. And they looked at me and they said, if you put that in here by fiat, we will fire you. So I, tail between my legs, I went out to the elevator, and I got out there, and Tendler's standing there, and then Rosenthal shows up, and Jesselson shows up. And guess what they asked me? Can you put that on our personal portfolios? Now think about that. When you're the principal, when you're the trustee, when you're the investment committee, these are people who are, calling the shots for somebody else. And it has an incredible effect on people. Warren Buffett's a perfect example. It's his money, basically. It's his money. And it's not that he doesn't care how you feel about it, but to me, that's a good way to run money, as if it were your own, own money. So I'm going to pretty much stop there. Any of you ever heard of, well, I'm not going to quite stop because I've just thought about this guy. Puggy Pearson, you ever heard of Puggy Pearson? He was one of the greatest gamblers in the world. He wore a top hat and he was very good. And Puggy did a handstand in 5th grade and his nose got pushed. Puggy Pearson. So anyway, Puggy's got this red hat on. He goes around Las Vegas making tons of money off of these croupiers or whatever. And his whole thing is, know the odds and don't go beyond them. In other words, just know the odds. The best you can know what your odds are. And of course, in gambling, they're fairly straightforward. And don't overextend yourself. I think that's a pretty good lesson. And so the P's are, watch out when you're making predictions. Understand the pressure that's being put on you, and be vigilant if you think that pressure is not right. The whole concept of how you feel in a negative environment is incredibly important. And the last thing is sort of whose money is this anyway? Who are the principals? Who are the agents? And sometimes it's very hard for agents to convince principals that they do something that they don't want to do, even though they've hired you. It's very hard to convince people, it has been very hard to convince people as a modern day issue, that there's something about low volatility that's really important. And the important part is that when the earning estimates come in for medium to small-sized companies, 18 months ahead of time, they're generally 40 to 60% higher than they turn out to be later on. So they just have this downward slope. So there are games that you can play there in terms of other people's personalities and behavior that can be very helpful when you invest. So please use that, because you can use it across a manager's grid, you can use it across a client's grid. You put the 4 Ps down and you put the types of things you deal with, and you'll find something in behavioral finance that you can fit in every single box. That will be, I think, hopefully very instructive for you. Thank you very much.
Arnie, just a minute on Martingale, which you've managed for a long time. What would you say was one of the key secrets to your longevity and success in that firm?
Well, I would say persistence is one of them. You have good and bad runs. We know that, the famous 7, Warren Buffett's stuff, that, the greatest investors in the world, they all went through, some of them went anywhere from 2 to 3 years with lousy performance during their full stint. You can't get through that now. I mean, people want to get rid of you if you have 2 bad years. We have clients who say, we're a long-term investor. Can you give us those monthly reports so we have the last month, then 3 months, then 6 months, and out here is, the longevity of the account. So I think our success has been diligence, sweet talking probably to a certain extent, working very hard with clients on the concept of the theories we've just talked about. And I think the other thing that has helped, and I thought it was kind of polish, is we have an academic advisory board. I mean, I love the academics. I mean, I don't fraternize much with people in the business, mostly with academics. So we have this wonderful academic advisory board who come in, often, and we just talk about what's going on. For instance, I've always been a big fan, and I was, 40 years ago, on using words instead of numbers to try to understand what management decisions were going to be. That's a huge paper now at Harvard. In other words, how do you use words to figure out what management's really telling you and how their company is doing? And I find that kind of stuff very fascinating. So I think I'm 60% academic and 40% investment guy. That's how I'd answer that.
Thanks, Arnie. Okay, we're going to open it up to questions from the audience. I've told these 3 that you're not a shy group, so please don't disappoint them. Any questions from the audience?
Anything.
I'll start with one. You talked about, thanks very much, by the way, for everybody. We talked about institutional investors, we've talked about individual investors, but there's another way you can draw the line. One is investors, whether institutional or individual, that are still receiving new money into whatever account they're investing in. The other is accounts that are essentially closed to new money. So example would be, for an individual, a person who's still earning versus a person who's now retired is decumulating. On an institutional side, it would be a public charity that receives new gifts versus a private foundation that typically does not. In this volatility, in this behavioral environment, have you got any wisdom as to how those 2 types behave? Because the latter group is not going to be able to dollar cost average into a recovery and is going to have to live for a longer period, notionally at least, with the results of whatever the market has given them.
I'll just answer briefly. That's true. If new money's coming in, there's nothing to dollar cost. Again, this comes from Ruane. Never have in the market anything you want to spend in the next 2 years. It's too short term. You have no idea of where it's going to be. So if you're going to be making, say, in a foundation, you're going to be making bequests or spending money, and you're going to be spending it. This is June. In next February, that money should be in bills now, or some cash equivalent. It shouldn't be riding for the next 6 months in any money. No one knows what's going to happen in 6 months. That's not investing. That's rolling the dice. That's like if my kids are going to college, I don't wait to sell for tuition money that month. I just have an advance. That's seat of the pants, what I would say.
Well, the hot thing right now is rules-based. Fidelity's doing this and everything, and I think they do a good job, as do other funds such as Vanguard and so on have written papers on this. I mean, I've written on this sort of thing, but basically to have have a plan. Just don't sit around and think, oh my gosh, the market could go down or the market could go up. But particularly individuals, they go through different cycles in their life, and some days they can put money in, some days they can't as they get older. But I think the whole rules-based thing is very valuable, if for no other reason, just the talking points and preparing yourself to make more sane decisions when all hell breaks loose.
I guess I'd speak from, not from the academic perspective, but I mean, I'm involved with two organizations, very different organizations that face this. One is United Auto Workers Medical Benefits Trust, which was designed to put a lump sum of money to deal with a bunch of liabilities, and then a foundation that is a charitable organization. And the thing that's most acute about helping those organizations make decisions and think through is that all your eggs really are in this one basket, and it does change your level of risk aversion. And in both cases, the answer is, well, if something happens, you have to adjust the liabilities, and there couldn't be two more different and painful kinds of adjustments that you could imagine. So that it just heightens the importance of thinking from an investment perspective when you don't have a safety valve.
One of the things that stuns me is that people are so underinvested in index funds. I don't get it. I mean, the numbers are very clear. I mean, I've worked on those projects with Vanguard and so on, and it's just, after costs particularly, costs are really scary, and I don't think people, even institutional people, really get that, and that sounds a little snobby by my saying that, but I just am really amazed that more people don't have money in, a NASDAQ index or, low volatility index or something like that. They have really stars and stripes well above what the average person is doing out there, average corporation or average foundation. They pick managers. I don't understand how. I'm in the business, and I still don't understand how managers are picked. Is it the cut of the jib, or is it the numbers, or what is it? It's pretty scary. Hope I don't have any clients in here.
Just to expound on that, you said you're an inveterate indexer. Can you just describe more your process? No active management? What sort of indices? What sort of time?
I have, in percentages, I have roughly 20% of my money in things that most of the people in this room have never heard of. They're startups. They're like a, and some of them go broke. Myomo, it's a thing that you put here, and you had a stroke and you haven't been moving, and they put this thing on you, and it hooks up to your brain, and you can pick up a drink. I mean, those sorts of things, and I have literally lots of those. The other side of it is I just feel much more comfortable in indexes, and I don't feel very comfortable in cash ever. I mean, just think about how much that hurt people when they thought they were that smart. I mean, I won't mention names, but it was a huge organization with a lot of money when I was at Battery March, and we hit the bad market, and got the call from some guy named Larry who said, "Take it all out." And I said, "I'm sorry, remove all of our assets from the stock market that we have in the stock market, all of them." And I said, he was pretty sure about himself, and I wasn't about to argue it, and so we did. And of course, we know what happened after the '87 market. Everything kind of flipped around, and but they stayed out for almost 4 years.
Arnie,
So you get those adventures.
Arnie, how do you deal with indexing in the sense that it's a strategy that if followed to the ultimate extreme,
Yeah,
couldn't
that's-
work. So everybody indexes.
Yeah, that's a good
Nobody's
point.
out there picking stocks. The whole world is ratifying every day the
Yeah.
prices, the relationships
Yeah.
of the prices.
I-
So it, which is not like value investing. If the whole world, each person did their best to think about, which stock was best, which has the most value for the price, and so on.
Yeah.
Some people do better than others, but the world could keep going on in that way.
Right.
But, and maybe we're probably far from this sort of speed of light, weird thing that would happen if the whole world were indexed. But that's the question.
It doesn't bother me. I'll tell you what does bother me about indexing is that it doesn't get a lot of drawback when you do get bad markets, which is, helpful because it's there when hopefully eventually things turn around. What scares me is we get to the point where so many people index that those who don't, that do index, in bad markets, the only place they can find liquidity is in their indexes. So they start selling the index like crazy. And that's a bad dream, imagination, whatever you want to call it. But I could see that day happening where so many people are in the indexes that there's no place to sell, so they have to just drop the market, period.
Particularly people who've gotten used to the idea that they can't lose money because they're in an index, which, people.
Relatively
a
loose,
lot,
yeah.
a lot of people have come into indexes in the last 10 years. Life's been pretty good. They've gotten used to thinking that life's going to stay very good. Markets don't stay, I think, at 24 times forever. They don't. They never have anyway for the last.
I don't understand bitcoins. Would somebody explain those things to me? Anyway, it's a very good question. And I think hopefully we're some way off from that, if at all.
Wait, Liz, you had a question. You want to ask
I
it?
was just going to ask the panelists if there was one mechanism or one change to make us better long-term investors. What might it be?
Don't look at the portfolio.
I would say that the statistics that we have are useful, and understanding what Arnie says, know the odds. I think that is that's one way you can keep training yourself when the news bombards you. Is that's one of the things that Roger Ibbotson did with his company, was produce these long-term charts and statistics about what the indexes were doing, and it's been very useful over the years to go back and see the line moving up, and then other people have done it for other countries. Dimson, Marsh, and Staunton did it for maybe 21 countries, and the equity premium is there. So if it's the stock market you're thinking about, the statistics is one. That's what I'd suggest.
Bill mentioned earlier private equity as a way of putting golden handcuffs on and keeping it from trading. And I think that idea has a lot of merit. Not everybody's going to put all their money in private equity, but if you did a thought experiment and said, suppose they only open the stock market once a year. You own what you own, and on January 2nd, say, you can make changes. My guess is actually most of us would not make many changes. You'd start sometime in mid-November or something, you'd start to think about it, assuming most things are going okay. But we don't invest. They're open every day, virtually all day. If you're not holding stocks for at least on average 2, 3, 4 years, you're really short-term trading. I would just say, ask yourself, do you want your money to be traded in that form? And if not everybody's capable of holding long-term, if you're not, then have someone else do it or buy the index. Because then you're really just reacting to the CNN. You're not really investing. The holding periods are very important, and they're really a window into how you're doing what you hope to be doing.
I'll give you a scary thought. Wonder if I could create a public private equity fund that could be priced daily, was completely transparent, and was liquid. Ever think about that? I thought about that a lot, and cost you 50 basis points. It's a pretty scary thought. There are people working on that sort of thing.
Peter?
So we talked today mostly about public equities and how to behave in a long-term rational way around stock markets. But can you chat a little bit about the role of asset allocation as it relates to being a long-term investor, and give us a sense for whether you think that matters, and if so, how would you allocate today?
Well, asset allocation really explains a lot of cross-sectional variation in returns. I mean, that's another interesting study, which is, you take a look and ask what matters. It's less about the manager you pick and more about the asset class. And if there's one thing over the last 30 years that has emerged in investing, is the capability of broadly diversifying your portfolio. So my office is just up the street from David Swenson's at Yale Endowment Office, and I would say, yes, he's an amazing manager selector, but even if their skills at selecting managers were only average, the diversification across, devoting some money to venture capital, to real estate, and so forth, when it wasn't so popular, turned out to be a pretty amazing decision. So I would say, start with a longer list than you might imagine, and then work from that. Consider a broader variety of investments, because we've moved from the 60-40 in my career to something that's got that taps into the potential of all sorts of different payoff streams.
I'll be contrarian and say I think the Swenson model has led to a vast over-diversification. In fact, most endowments now, the average endowment, are trailing the index. But if you have 80 different funds, and each of them is invested in 140 different securities or something, you're owning zillions of assets. You might as well be in an index, because you're not going to do better, you're going to do worse because there are fees. And the what I would call the consultant approach of having a grid with boxes and then saying, put this much in this box, this much in this box, is not an approach that takes into account price and value, which is, to me, is the essence of investing. If you live in America and you're going to live in America and you're going to spend your money in America, you really need to grow your money in dollars, in real terms, over time. You don't really need to be in South African rand, and so on and so on. Now, you may find opportunities there, fine, but the idea that you have to own mid-caps in the Czech Republic and this there and that there, I'd rather own 35 well-chosen securities than more than I. And I'm not the person who can find them, and many people can't, then I'd rather be in an index.
So I'll push back, since you did so too, and I have to agree with you on the premise that
That's no pushback.
I think you're 100% right, which is, if you start with a grid and you ignore where the value might be, then that's a recipe for mediocrity plus fee. But the value is real value is more likely to be hidden in places that other people aren't necessarily looking. And I'll give you an example. John Maynard Keynes was this. He was not only a great economist, but he was a fairly successful investor. And some of his success came from unusual bets. Like when you said South Africa, I think he invested in some companies in South Africa. And the reason being that he saw the potential for value. And the result was some diversification, but probably the incentive to do so was not the diversification. So That's the way I would interpret what you said.
I want to say one more thing about the Swenson model, which has been so widely imitated. Swenson didn't just go into any venture capital stocks. He had on the board of the endowment and among the alumni and faculty at Yale, he had his hooks into the best guys starting up companies. They were all guys then. In the country and maybe the world. And what's happened then is, in a sort of a cookie-cutter form, every endowment has said, well, I've got to be like David Swenson, I need some in this sort of fund. But not everybody has David Swenson's faculty, board, and alumni group. So it's, it's
Or
not,
Charlie Ellis running his committee.
So it's not replicable, and it hasn't been replicated. Look at Harvard. So,
Yeah. Yes.
I've got a question for you related to artificial intelligence. If we're talking about statistics showing that long-termism is actually a better, smarter way to invest, do we think that AI can get us there?
There's no artificial intelligence on the panel. but-
I played around with AI tools, and the one thing that is so disappointing about it is that you train them to the peak of perfection, and then you use them out of sample, and they don't work very well. So that's been the frustrating thing. The only thing that was interesting, the only thing that I found that works for me personally in building those models is if you know that there is a structure that exists, and all you need to do is find it. People hope that there's a structure to the stock market and there's a lot of randomness. So they turn on the AI and they hope they can find a pattern nobody else has found. But the place that I applied it was I tried to reverse engineer the Dow theory. And I know the person that was writing those articles had some kind of theory that they were using. All the AI had to do was to reconstitute it from their calls and so on. And there it worked pretty well because there was an existing structure. But I think that I know that it's widely used in hedge funds. I know that there has been some success, but I think the premise has to be that you use it in places where there is some underlying structure or logic.
yeah, I think the premise that there's some sort of talismanic significance to the historic stock prices. As Bill said, people have been building models based on this stuff for years. It's very easy, based on what happened in the past, to build a model that completely explains the past. It just, before 2008, the odds of having a collapse of however much it fell in a century was once a century. And now it's twice a century. I mean, this is what long-term capital management, ran aground on. They had terrific models, and they knew exactly from the models how much they could lose in a given day because they knew the volatility of their assets and everything. Until the volatility's changed, I don't know how any artificial agent gets past that unless they can read the future. That's some other kind of intelligence. So,
Would that help in your area, Arnie?
Probably not, because we really don't know. We don't know how to detect what people are going to think at any point in time. And I'm not sure artificial intelligence is ready yet to do that. So I have a lot of respect for artificial intelligence, and I think it's going to be a major event in the investment business, but I just don't know how it's going to be applied. I mean, we all do the, we're as techie as anybody in terms of looking at things, and, we just, we don't find any great uses for it at this point.
Other questions? Well, I want to thank the panel for their time coming today and for their wisdom. Hopefully you all got something you could use and think about. Thanks very much.
Can I do one commercial?
Sure.
I want to do one small commercial. As some of you know, for 25 years, primarily because the business school was not interested in having it. There has been a behavioral finance course at Harvard Kennedy School. Will has spoken at, there's a lot of very high intelligent people have spoken at this for years, and it's a 3-day program in November. So if you want to know a lot about that, you can ask me to send you the one that's coming out for next year. But you'll see people like Michael Mobison and Jason Zweig and all sorts of people talk. Jason talks about fear and the amygdala. I mean, it's really pretty interesting stuff. So if that's of any interest to you, just you can send me a note or whatever. And if you want a book on behavioral finance, those are the best authors I could find. They're very short articles, so if you don't like one, you just go on to the next one kind of thing. Bob Schiller's in there, Zeckhauser's in there, Dean LeBaron's in, their whole gang in there that are just talking about different aspects of behavioral finance. So if that's of interest to you, there's a shortcut to learning a lot in a very short time period. Sorry, I'm definitely aggressive about this stuff.